Hey, it's Matt Decker with Cash Value Life Insurance Reviews here on YouTube. I also own and operate Leveraged Wealth Management, where we specialize in tax-free retirement income for high earners. We get asked a ton in the comments section, as well as just emails or people coming out to the website and sending us a quick comment or a chat. They'll say something along the lines of, hey, I have a bad life insurance policy. I've watched your videos, and from what I can tell, I have a bad policy. What do I do now? And so that's what we're going to talk about today. What can you do if you suspect or think that you already have a bad life insurance policy? So first things first, if you're not sure what a bad policy may look like, or you're not quite sure if this fits for you, we've done a ton of videos on what makes a policy good or bad. And so we'll link those up here above with the call out card. You can go and you can check out those videos and you can determine for yourself if you've got a good or a bad policy. Unfortunately, though, the solutions are limited. There's not a lot that we can do with policies that are already in place. And that's why we harp so much on the fact that these things need to be set up right from the beginning. The design is super important. The design is more important than, in most cases, the company that you choose to work with. And so when someone does come to us and they say, we have a bad policy, what do I do now? There's not a lot of good options, but we're going to go through them here with you. So the first thing that you can do, and I suppose it probably depends on how old the policy is. So let's start with the policy that's less than 7 years old. So if you have a policy that's less than 7 years old, and you suspect it's not the greatest policy out there, what can you do? Well, the first thing you can do is you can adjust the premiums. And so in most cases, this isn't a great solution, because when we say adjust the premiums, typically what we're going to mean is you're going to increase the premiums. And for a lot of people, when they get into these policies, the way that agents are incentivized to sell them, they're going to sell you more death benefit than you probably need relative to the premium that you're paying. And so in order to make that design feasible, a lot of times it's going to mean you're going to have to increase that premium. And unfortunately, there's just a lot of people that can't do that. But if you have good cash flow, and you have a policy that you suspect maybe is not designed the right way or is underfunded, you can adjust the premium. So let me show you an example of what that might actually look like. So this is a Mutual of Omaha policy, and we're paying $25,000 a year into this contract. It has a $1.2 million death benefit. And you can see that over time, this death benefit is increasing. It's pretty easy to see. It starts at 1.2, it increases to 1.6 million. Well, in this particular example, because I ran this as an example so we could talk about it, I know that this policy, that this $25,000 premium, this is an underfunded policy. This $1.2 million policy, and this is for a male age 45 preferred non-tobacco. This policy should have a whole lot more dollars going into it than $25,000 if the goal is maximum cash and accumulation. And so let me show you what I'm talking about. This particular policy is not necessarily designed poorly unless you absolutely needed to pay no more than $25,000. But if you have premium flexibility, if this is an asset reposition, then maybe this could work. We would simply adjust your premiums, and we would adjust your premiums to this guideline maximum level of $70,000. And so you can see why this could be a problem, right? If you get into this policy and you tell the person you're working with, I don't want to spend any more than $25,000 on a policy. Give me something that's a good design. And they send you this policy, $1.2 million death benefit. You're paying the $25,000. You see that it's an increasing death benefit. And so you think, oh, this is a good policy, right? Matt always says, make sure it's an increasing death benefit. Well, you'd be wrong. You'd be in a tough place if that was your situation. If this was an asset reposition and you had the ability to maybe pay in this $250,000 of total premium, but maybe you could do it faster. Maybe you could do it in 4 years or so. This policy could still work because this policy has premium room for $70,000 a year if you're going to pay it forever. If you're going to pay the premium for around 4 years, you can actually pay $92,000 a year. So in this policy, it could accommodate the total $250,000 in premiums in a shorter duration, and this would work. This would be a solution for solving a bad design if you had premium flexibility. Unfortunately, most people don't have premium flexibility. So the first thing that you can do if you suspect you have a bad design and you have some premium flexibility is you can adjust the premiums, and typically you're going to have to increase those premiums. The second thing that you can do if it's a really bad design and it's less than 7 years like we say, and really we would mean probably inside the first year, you can cancel. You can go ahead and cancel your contract. Now, if you cancel your contract, you're not going to get any money back, more than likely, especially if it's less than a year old. And you're really just chalking that up as, I assume, a lesson learned. Maybe you didn't look into it as much as you had. Maybe you put your trust in the wrong person and they led you astray. Whatever the reason that might lead you to cancel a policy, it's an option if it's a really poorly done policy and you're inside that first year. Now, let's say that you decide you want to cancel a policy and you're not inside that first year. Maybe you're 10 years out, 15 years out, 20 years out, and you want to cancel a policy. There's two major things that you need to be aware of. So the first thing is, are there going to be surrender charges? Now, these will typically be in play definitely inside the first 10 years in most cases. So you'll want to make sure that you know what the surrender charges are. And then the second thing, if it's an older policy, this is going to come into play, are going to be taxes. So if you end up canceling a policy where you actually do have more cash than premium paid, you will be taxed on the difference between the cash value that you surrender out and the total amount of premium paid. So you just need to know, if you do plan on canceling a policy, you need to check surrender charges, and you need to make sure that you understand the taxable implications of canceling that policy. The next thing that you can do is what's called a 1035 exchange. Now, 1035 exchanges happen quite a bit, and there's pros and cons to doing a 1035 exchange. So let's talk about that for a second. So the first thing that I would say is a con of doing a 1035 exchange is the fees are going to start over because you're moving into a new policy. And when you move into a new policy, the surrender charges start over, the premium loads start over, the per face fee or the per unit charge is going to start over. And so you can't just 1035 a policy and it always work out for the better, even if it's a bad design, because of things like all the fees starting over. So it's something that you have to look at pretty carefully. You'd want to know if you do 1035 this policy, and since these fees do start over, where's your break even? Because you're probably not going to break even in the first year. You're surrendering a bad policy for a good policy, and more than likely, you're going to go backwards in the short term. So you're going to want to know what's your break even point if you move into a new policy because you figure out that you have a bad design. Now, where can a 1035 make a ton of sense? 1035s can make a ton of sense in older policies that have bad loan provisions or bad crediting options. A lot of times the new policies have newer index options, maybe more flexible loan provisions. They might have some different bells and whistles that maybe you want, like a long-term care rider or something like that. So where a 1035 might make a whole lot of sense is if you've had like a whole life insurance policy ever since you were a kid. It might even have a juvenile rate class on it still, and maybe now you're in your 40s. Those policies can often be 1035 and you put into a much better position. But you just have to be careful with 1035s. If you're going to 1035 early, you need to make sure you understand where your break-even point is. You need to understand that the fees in the new policy are going to start back over. If it's an older policy, those fees do still start back over, and you are going to probably move from a policy that has no surrender charges into a policy that has surrender charges. And so you just need to be aware of that. But a lot of times a 1035 can be a good option. The last thing you can do is nothing. You can just decide that you're going to keep your policy. Maybe it wasn't a great design, but maybe things change. Maybe you started it with the idea of wanting as much cash as possible. You got a bad design. You don't want to eat any surrender charges. You don't want to go through the hassle of getting approved for another policy, and you just decide to keep what you have. A lot of people decide to keep what they have because something is going to be better than nothing. I can almost promise you that, unless the design is just not redeemable. But with most policies and most agents out there, even if it's a bad design, it can still work in some use case. So do nothing might be somewhat anticlimactic. And I can already kind of hear people screaming in the comments that we can lower the death benefit. And that is true. You could lower the death benefit if you have a policy and you suspect that it's a bad design. But here's what you need to understand, and I want to be really crystal clear. One of the biggest fees, if not the biggest fee on the policy, is called a per unit charge or a per face fee. It is a flat fee. Let's just write this out. So we'll say it's a per unit charge. It's a flat fee. Typically, it's going to stay on the policy for 10 to maybe 15 years. And it does not change even if you drop the death benefit. The only fees that will change if you drop the death benefit on a policy that's already in place are going to be the cost of insurance fees. And in the early years of a policy, the cost of insurance is not large at all. Let me show you an example of what I'm talking about here. So let's look at this Allianz policy, because they've got a nice policy charges ledger here that's super easy to read. And you'll notice that they line item out all the charges. So there's a premium charge, there's a policy fee, a per unit charge, a cost of insurance, riders, asset charges, and they give us a total here. And of course, we are talking about the per unit charge. So why is dropping the death benefit not a very good option if you have a bad policy design? Well, let's just say that you could cut your death benefit in half. The only fee that you're going to change by cutting your death benefit in half is the cost of insurance fee, which is only $648. So at best, your cost of insurance fee goes to $320. You save $320 a year. Your per unit charge is $1,500. If you had cut your death benefit in half from the beginning, if you started with a good design, your per unit charge is probably $750. So cutting the death benefit down to solve the problem of a bad design, it's just not the best way to go about it. And in fact, we've seen instances where someone will drop their death benefit because they think they have a bad design. At best, maybe they're saving $300 a year. And then guess what happens? They get sick. They can't get insurance anymore, and they wish they had the death benefit back, and now they can't get it. So because of that reason, I know people will say in the comments, you can lower the death benefit, and I say, that's not a very good option. You'd actually be better served by taking any of the other four options and not lowering your death benefit, because life insurance as a death benefit does have a value, and maybe the $300 that you're saving in fees to cut your death benefit in half, it's just not worth it. So if you have a bad policy and you're not sure what to do with it, there's really only, 4 options. You can increase your premiums to accommodate maybe the more room that the policy has. You can cancel your policy, and if you do, make sure you know what the surrender charges are. Make sure you know that there's any tax implications for canceling that policy. You can 1035 the policy into a new policy. That has pros and cons, or you can do nothing. You can just decide to keep the policy that you've got. If you're in a position where you suspect that you do have a bad policy and you want to talk through these different solutions with somebody who's an expert in this field, I would encourage you to book a discovery call with us. We can chat about the policy you have. We'll ask you why you bought it, what you're hoping it will do for you, and then we'll discuss your options here on adjusting the premiums, 1035ing, keeping it, or canceling it, and we'll try to come up with a solution that's going to best fit your goals as they are right now today. So hopefully this has been helpful. This is Matt Decker with Cash Value Life Insurance Reviews and Leverage Wealth Management. Until next time.